If you own real estate or you're planning to build a real estate portfolio, there is one decision that quietly impacts everything else you do, and most investors rush through it. That decision is how you hold your property, not which market you buy in, not how good the deal looks on paper, but the entity you use. Because the right structure can reduce taxes, protect your personal assets, and make growth easier. And the wrong structure can quietly expose you to lawsuits, limit deductions, and create tax problems that only show up years later. So today, let's slow this down and talk clearly about choosing the right entity for real estate, balancing tax savings and legal risk. This is not a legal theory. This is practical planning. Every real estate entity choice is a trade-off. On one side, you have tax efficiency, how income flows, how losses are used, and how deductions like depreciation actually reduce your tax bill. On the other side, you have legal protection, how well your personal assets are shielded if something goes wrong at the property level. The goal is not to maximize one and ignore the other. The goal is to balance both, based on how you invest and how your portfolio is evolving. Why does entity choice matter more than most investors think? When a property is held in your personal name, everything flows straight to your individual tax return. That's simple, but it also means there is no separation. If a tenant slips, if a contractor dispute escalates, if there's an unexpected claim, your personal bank accounts, your home, and other assets can be exposed. From a tax standpoint, holding property personally can also limit how flexibly losses and deductions are used, especially as income grows. An entity creates a container. It organizes income. It controls risk, and it sets the foundation for tax planning. Moving on, let's walk through the structures investors actually use and what they really do. Holding property in your personal name. This is common for first-time investors or single properties. It's simple. There's no separate filing. Income and expenses show up directly on your return, but there is no liability shield. And as your portfolio grows, simplicity becomes exposure. This structure rarely scales well. Limited liability companies, or LLCs. This is where most real estate investors land, and for good reason. An LLC is typically a pass-through entity, meaning the LLC itself doesn't pay income tax. Income flows to the owner's return. From a tax perspective, depreciation flows through cleanly. Interest deductions stay intact. Losses can be used subject to passive activity rules. From a legal perspective, liability is generally contained within the LLC. Problems at one property don't automatically spill into personal assets. LLCs also allow flexibility. You can add partners, separate properties, or create layered structures as the portfolio grows. This balance of tax efficiency and protection is why LLCs are the default for many investors. Partnerships. Partnerships are common when multiple investors are involved. They allow income and losses to be allocated among partners based on agreements, not just ownership percentages. That flexibility can be powerful, but only if agreements are drafted carefully. From a risk standpoint, poorly structured partnerships can accidentally expose partners to each other's mistakes. This is where professional guidance matters. S corporations. This is where many investors get tripped up. S corporations can reduce self-employment tax in operating businesses, but they often create problems for rental real estate. Property transfers can trigger taxable events. The basic rules become restrictive, and flexibility is reduced. For most rental portfolios, S corporations are usually not the right holding vehicle. C corporations and real estate investment trusts. C corporations introduce double taxation, which usually makes them inefficient for holding rental property. Real estate investment trusts are highly specialized structures designed for large-scale or institutional investors, not hands-on property owners. For most individual investors, these are rarely appropriate. Now, let's connect entity choice to tax strategy. This is where things get interesting. Entity choice directly affects how powerful tax strategies actually work. Depreciation and bonus depreciation flow through pass-through entities. Cost segregation works best when the basis is tracked cleanly. 1031 exchanges require proper ownership and documentation. With the restoration of 100% bonus depreciation under recent law changes, entity alignment matters more than ever. The wrong structure can limit or delay deductions that should be working for you immediately. Legal protection is not optional. Now let's shift gears. Tax savings are important, but legal exposure can erase years of profit overnight. Entities are not about avoiding responsibility. They are about containing risk. An LLC doesn't prevent lawsuits. It limits the damage. Without an entity, one property problem can affect everything else you own. With the right entity, issues stay localized and manageable. Why does one entity rarely fit every stage? Here's something many investors miss. The structure that worked for your first property may not work for your 5th or 15th. As portfolios grow, risk increases, cash flow changes, exit strategies become more complex. Strong investors review their entity structure regularly. They adapt as laws change, portfolios expand, or strategies shift. Entity planning is not a one-time decision. It's a living framework. What smart investors do differently? They don't ask, what's the cheapest setup? They ask, how does income flow? How are losses used? What happens if something goes wrong? How does this structure support future growth or exit? They treat entity planning as part of investment strategy, not paperwork. Choosing the right real estate entity is not about chasing loopholes. It's about building a structure that supports tax efficiency and protects what you've built. When done correctly, your entity reduces taxes legally, limits legal exposure, makes growth easier, not harder. At Gav Tax Advisory Services, we help real estate investors align entity structure, tax strategy, and long-term planning into one coordinated framework. If you're unsure whether your current structure still fits your portfolio or you're planning your next acquisition, visit gavtax.com and schedule a consultation. Plan before problems show up, not after. Thanks for watching. I'll see you in the next video.